Hi everyone and welcome to the Everyman Investor. So today I'll be taking a look at the week from 30th October to 3rd November 2023 where a whole bunch of economic data dropped as well as the Fed's decision on the interest rates as well as Apple's current fall in the share price. So now let's look at the jobs data that has dropped over the past week. The jobs data has in general been very favorable. So the ADP employment forecast, which is basically the private jobs openings, forecast came in at 130,000, but the actual number was 113,000, which is lighter, which is excellent for a stock market investor. Jobless claims also were above forecast. The forecast was 214,000, the actual was 217,000. The labour cost forecast was 0.7% increase, but the actual one was negative 0.8% decrease in labour costs. Now for non-farm payrolls, which is basically all jobs excluding farming jobs, and includes both private and government job openings, the forecast was 170,000, the actual was 150,000, which is again light. And the unemployment rate was forecasted to be 3.8%, but the actual was 3.9%. For hourly wages, the forecast was an increase of 0.3%, but the actual was an increase of 0.2%. So overall, the jobs data show us that employment cost is moderating, jobs openings are decreasing, and unemployment is increasing. Now, what is bad for the jobs market is actually very good for investors because all these basically signals deflation, which is what the Federal Reserve is trying to aim for. And unfortunately, it will take a weaker jobs market in order to deflate current prices. So now let's take a look at economic data. So economic data is divided into manufacturing and services. So manufacturing will be the production of goods and services will be the service sector. So for manufacturing PMI, which is basically a survey of managers in the manufacturing industry with regards to what they see is the manufacturing, how manufacturing is going about. So for a number above 50, it shows that they expect manufacturing to expand. And for numbers below 50, the managers expect the manufacturing to decline or to contract. So the forecast was 50 and the actual was 50, meaning to say that the managers basically think that manufacturing industry in US is actually just treading water. Now for the ISM manufacturing, this basically is an indication of activity in the manufacturing sector. So the previous data was 49%, again less than 50 is in contraction, and the latest was 46.7, which contracted even more. Now, productivity was good. The forecast was 4.3%, and the actual was 4.7%, which is excellent. Now, for the services PMI, the forecast was 50.9, the actual was 50.7, which shows that although services is expanding, it is actually slowing down. And for the ISM services, previous was 53.6%, the latest was 51.8%, which shows again that while expanding, services is slowing down. Now, all this basically shows that manufacturing is contracting. Now, services not really contracting but slowing down, although it's contracting compared to previous data. And productivity is increasing. Now, again, this is all great news for us because it's again in line with deflation. The main problem being that if the jobs market continues to weaken, services drop into contraction territory, and manufacturing continues to remain in contraction, then will that lead to a recession? So let's continue to keep a close eye on all this data as it comes out over the next couple of months. And let's keep a close eye on our investments or our potential investments, picking companies that have got good profits, growing profits, and also low debt. So what did the Fed make of all this data that came out over the past week? Now, there was no increase in interest rates for the November 2023 meeting, which was great. The market has rallied since then. Now, the problem is that the previous quarter's dot plot, which is basically prediction by the Federal Reserve members about where they see interest rates being for the next couple of years, shows that there's a very low chance of a rate cut in the next year, which is 2024. There's even a possibility of one more rate hike this year, although the Fed has currently been much more data dependent and has emphasized that it will be data dependent in making decisions about future rate hikes or rate cuts. So now we are waiting for the Q4 dot plot because dot plot is released every quarter, and that will show us what the Federal Reserve's latest thinking is on either rate hikes or rate cuts going into the next year. Now the good news is that next year is elections in the US, and the Fed usually likes to keep things in neutral territory. They don't want to stimulate the economy because the incumbent will be able to benefit from that. They don't want to sink the economy because the incumbent will basically fail in the election bid or will have a lower chance of being elected if the economy collapses. So the Fed usually likes to keep things in neutral territory, and hopefully let's avoid that recession that everybody has been talking about. But there is one more piece of information that dropped last week that was a bit worrying, and that is Apple. So basically, Apple, while it beats sales and EPS guidance, or rather expectations, it has shown that the overall sales has fallen for 4 quarters in a row. And basically the Apple executives do not see growth returning in the holiday quarter. In fact, they actually gave a very soft guidance for the holiday quarter. Now, if people are not spending in December, which is Christmas, then the question is how strong is the consumer? And if the consumer is not strong and economic data and jobs data continue to show weakening, that might actually put us in a real recession. Already Europe is in a recession. China is not doing very well. The data sort of goes up and down, and when it's too down, they stop releasing data. So the question is, how will the US economy do over the next few quarters and over the next year or so? I would say keep a lookout for for further releases of economic data and jobs data, and also a lookout on the Fed's dot plot when they meet for probably the end of the year, and when the data is released for the dot plot for the end of the year. And I'll keep you updated if anything significant drops. So thank you for watching this video, and I hope it was informative and useful for your investments or your investment plans for the next couple of months or next couple of quarters.